Caitlin, Manmohan, welcome back to Real Vision. It's a pleasure to have you both with us here today.
Thank you. It's an honor to be back.
Thanks for the opportunity.
So today we're going to be talking about stablecoins and the role that they play in the global collateral system. But before we get started talking about the digital asset aspect of this, you guys have been collaborating together for many years. Let's give a little bit about the context for your collaboration and the background on this important topic of collateral and assets in the global banking system. Caitlin, let's start with you. Give us a sense of where we're beginning from today.
Well, gosh, Dr. Singh, I've been citing his work. He's been at the IMF for many years, and he is most well known for his work on collateral velocity and collateral reuse, and basically helping us get a measure of the true extent of leverage in the traditional financial system. And I started using his work when I was at Morgan Stanley, and that's when we connected before either one of us really got involved in crypto. It was maybe, I would guess, about 8 years ago or so. And then, of course, that interest evolved into, okay, now if we have digital versions of collateral that settle in minutes with irreversibility on a blockchain, that might solve some of the collateral issues, the bottlenecks that have arisen in traditional finance, and also, very importantly, make it very obvious to everyone how long collateral chains are, and therefore how much leverage there really is in the financial system.
Yeah, Dr. Singh, that's a great introduction. Give us a little bit of the context for why this is significant, why the challenges of leverage are tied to collateral.
Okay, it's a very good opening question. Going back almost a decade, I had a paper around this time, 2011, on collateral velocity. This was the first paper. This is a term I coined because I noticed the shadow banking world was looked at in a very pejorative term, a very negative term. Just because we never understood what's going on, the rubric of shadow banking included many issues which I think you can see from the lens of collateral. In my space, along with money, which settle accounts, collateral settles as many accounts as money. So to look at the lubrication in the system beyond the lens of money was crucial. And I think over time, I've seen many central banks write papers on this topic of collateral reuse. Sometimes I get surprised because the regulators deem this is very bad leverage. There should be optimal leverage. At the same time, I will also notice that, say, in the Eurozone, they will encourage the use of government bonds because there's a shortage and you don't want their repo rate to be so far below the policy rate. So it's a very integral part of plumbing of the financial system. And even now, people trip over it. It is ironic. Some will view it as leverage. At the same time, for somebody who says, reuse is okay, given the legalities, I will endorse Caitlin's mindset, because in the stablecoin world, the one we're going to talk about, there should not be rehypothecation. There should not be reuse, because you need a genuine backing, genuine, very good backing. And as the discussion moves forward, we'll make a distinction between good collateral like treasuries or bonds versus central bank reserves. So that's where I'm coming from. The numbers are large, and you cannot remain myopic to financial lubrication just from money.
Yeah. Caitlin, Dr. Singh has mentioned this word rehypothecation, a word that many of us heard for the first time in 2007, 2008. Give us a sense of the significance of rehypothecation and how that can cause challenges through the system as leverage grows.
Well, first of all, what is it? It's repledging of an asset such that there are two people who report on their financial statements that they own the very same asset. And when we talk about the length of collateral chains, it's not ever just two. There's been a lot of estimate of, again, Dr. Singh's work, which is reliant upon public disclosures at quarter end. And we know big financial institutions do a lot of so-called balance sheet window dressing, where they bring their leverage down when they're filing their regulatory reports at quarter end or year end. But there's some estimates out there that intraday and intra-quarter that treasuries may be rehypothecated, say, more than 20 times. And so what that means, though, is that in order to, it basically, collateral is essentially the margin of the securities industry. So when there's a margin call, there's a requirement to post collateral. That's what this is all about. And to put it into context for those of you who studied maybe macroeconomics in college, you might remember hearing about the fractional reserve banking system through traditional banks, where $1 of the monetary base, M0, was injected into the traditional banking system. And within about 6 months, it turned into, say, $10 of M2. So the money multiplier was 10. That probably is sounding familiar to pretty much every listener who studied economics. But that's not how the financial system works anymore. The credit creation, it still works that way, but those money multipliers are now down to around 1.2. So that's not where the credit is coming from. The credit is coming from the collateral reuse in the shadow banking system, where the multipliers are higher. And again, very hard to measure. And what I would say, though, is I agree with Dr. Singh that as we switch to stablecoins as collateral in the financial system, we're going to end up, if the stablecoins are backed by central bank reserves, with a fundamentally more stable financial system than we have now, because credit creation relies so much on this concept of rehypothecation, and there's no transparency between the big banks as to, once they pledge collateral as a margin call, they don't know where their collateral went, because it can be unpledged and unpledged and unpledged and unpledged. And the fundamental problem for regulators with the way this system works, is that the accounting says, okay, each financial institution that pledges collateral reports it as an asset on their balance sheet, as long as they have a separate dollar of debt. But the problem with that is that it makes every financial institution look like they own the very same treasury, when there's really only one treasury. And so when you get a run on the repo system, which is what happened in 2008, you get a massive deleveraging, and it turns out that the musical chairs game stops. There really is only one treasury, and what we've seen is much smaller repeats of 2008 ever since then, where collateral velocity collapses, and you get a deleveraging in the system. And that typically is when central banks have to step in and expand their balance sheets. But I think we're going to be moving to a much more stable financial system if stable coins are allowed to get access to central bank reserves. It's not going to increase leverage in the system. It's not going to increase the total amount of credit in the system at all. In fact, actually, it just shifts it to a far more transparent, far more liquid, cheaper, better from a transactional perspective, but from the regulator's perspective, far more transparent as to how much leverage there really is in the system and who's got leverage to who else.
Yeah, very well said. And that perfectly sets you up, Dr. Singh. This is something you've been measuring for many years now. Give us a sense of how you think about the size of these and magnitude of collateral rehypothecation and how it moves through the system, and how you measure it in your scholarly work.
Well, again, it's a big picture question, but one of the interesting elements here is the degree of flexibility that the dealer balance sheets have. And when I talk about dealer balance sheet, I mean on balance sheet and off balance sheet. A lot of my work looks at the pledge collateral which moves off balance sheet. As long as it is nettable, Basel rules allow considerable amount of netting. For example, if the underlying is a 5-year repo with a 5-year position of the same underlying, you can net it. So the bottom line is, I find a lot of my numbers coming from off balance sheet, not on balance sheet. And these numbers have changed drastically. In fact, I think it gives you a sense of what's going on in the banking system. Like, one of my first numbers was 2007 for Lehman. UBS was a giant out there, about 1.4 in pledge collateral. You also had numbers from Lehman around 800 billion. And the last balance sheet of Lehman was 700 billion. Billion is a big number. These are almost $1 trillion worth of numbers. JP Morgan was not as big, but today, what UBS was yesterday is JP Morgan today.
Yeah.
And these footprints are immense. One or two banks with large reserves can control the repo market if they come in or do not come into the market. So just to complete my train of thought, the collateral velocity or reuse in a global sense. I notice a lot of people use it myopic just to measure the Eurozone velocity or Australian velocity. But I think since collateral is so cross-border, it gets a better sense if you can really get into all the banks. It's work, but it's worthwhile doing it. The numbers were around three. So, a 10 trillion of pledged collateral among the 15, 17, 18 big banks. And if you adjust it properly, you got a number like three. It really collapsed after the crisis. Numbers were 1.7, 1.6, partly because the balance sheets were forced to shrink overnight. The Basel rules were not yet in place, but they were being in process. So everybody was cautious. Banks were not very trustworthy. A Citibank's share was almost $1. There were many banks where you would not deal with as a counterparty. Then you had the Eurozone crisis. So this took us from Lehman all the way to 2015. And you finally got done with Basel. You finally got done with the Eurozone crisis. Come 2016, the numbers have started to rebound and they are up around 2.4. Why? Because banks figured out how to dodge the bullets. You have some new entrants. The Canadian banks have come in. Nomura has come in. HSBC has come in. So you start seeing the geography changing, the size and footprint changing. UBS is not big anymore. Deutsche Bank is decreasing. But the bottom line is the collateral velocity is up. Now, you can view it negatively or positively. For many transactions like sec lending in the Eurozone, I view it positively. I don't see that type of sec lending here in the US. But the bottom line is if dealers get space, this is one way to use off balance sheet without corresponding capital. You may argue that's not negative. Well, you may argue that's not the right way to do things, but it's legally okay. And if collateral velocity is coming up, we need to understand it because it has implications for lubrication. One thing I forgot was all the QE. That also takes away good collateral from the market. If you have less good collateral, you have less chance to reuse it. So all these issues which I've mentioned from the crisis, Eurozone crisis, bank balance sheets and Basel, QE, shrunk the balance sheets. But as I mentioned, balance sheets are a bit elastic now since the banks and some new entrants have allowed to sort of make a market in collateral. I think it's an important theme. You like it or not, but QE and the fact that central bank balance sheets are not unwinding leads us very, very importantly to a topic about stablecoins.
Hey, if you like this clip, be sure to check out the full interview and more only on realvision.com/crypto. It's 100% free. Sign up now.